Chapter 9 of the financial playbook for Gen Z. Let's jump right in. Chapter 9, build passive income streams. Create multiple streams of passive income through business ownership, the stock market, and real estate. This is essential because work becomes optional when your passive income exceeds your cost of living. I'll say it again. Work becomes optional when your passive income exceeds your cost of living. When your passive income exceeds your cost of living, you have achieved financial freedom. In other words, financial freedom is when the money your money makes for you is enough to cover your cost of living. Therefore, you don't have to trade your time for money. Again, work becomes completely optional at that point. Now, Warren Buffett once said that we must figure out ways to make money in our sleep, or else we will have to work until we die. What he really meant was that we need to develop passive streams of income. Now, let's clarify two important aspects of the money-making game. Active income is the money coming in as a direct result of your time, right? Active income is where you're trading your time for money, but passive income is money that flows as a result of upfront work, but requires minimum time to maintain. So in other words, passive income is when your money is making money for you, right? So build passive streams of income. Now, let's talk about streams of income, right? The first step is to understand the 7 types of income streams, right? Because understanding the 7 types of income streams will allow you to maximize your money made through each avenue, and more money, right? More money will continue to flow. So let's go through the 7 types. There's W-2 income, there's business income, there's interest income, there's dividend income, there's capital gains income, there's rental income, and there's royalty income, right? Now, ultimately, you want to understand these different income streams and think about ways in which you can have multiple streams of income. The 7 types of income streams. If you understand this material, you will understand how to achieve financial freedom. Because put simply, financial freedom is building streams of passive income so that your passive income exceeds your cost of living. Now, I know it's easier said than done. And understanding all the facets of the personal finance world is key to really making progress on your path to financial independence, right? So let's go through this. W-2 income, all right? W-2 income is income from work that you do as an employee. This is active income, right? Because it requires you to trade your time for money. And it is the most heavily taxed type of income, right? Now, number 2, business income. Business income is income from operating a business. Now, the advantage of this type of income is that the IRS allows business owners to take a wide range of tax deductions. Now, always remember this, the tax code is designed to benefit business owners and investors. If you are working in the business, this is active income. But if you hire people to work the business for you, then it becomes more passive in nature, although you still must oversee the operations, right? You will still need to work on the business, but you don't need to necessarily work in the business, right? Now, number 3, interest income. This type of income is completely passive in nature and is technically classified as portfolio income. An example of interest income is high yield savings accounts, right? In fact, I highly recommend that you put your emergency fund money into a high yield savings account, right? So that you can earn, more interest than the typical savings account, right? Now, research different high yield savings accounts, because like right now, it's September 2023. There are many high yield savings accounts that pay over 4% APR, right? So now another example of interest income is private money lending, right? Private money lending is another source of interest income. It's where you're lending money on private money deals. Now it's a more advanced type of lending, but you can make very high returns, like 14, 15, 16% APR, or even higher. Now, the next type of income stream, dividend income. This is income from distributions to shareholders. This type of income is passive in nature, right? With a great example is stock index mutual funds, right? Stock index mutual funds is a great example of dividend income because it's just where you are receiving dividends, based on your shares that you own. Next form is capital gains income. This income stems from the increase in the value of assets, such as mutual funds, real estate, etc. This type of income is passive in nature, very passive in nature. Next form of income is rental income. Rental income is income from the rental of assets, such as real estate, cars, equipment, etc. It can be either active or passive in nature, depending on your level of involvement. And the last form of an income stream is royalty income. This is income from selling the rights to use an asset, such as intellectual property. Examples include books, online courses, YouTube monetization, etc. And this is considered passive income as well. Although, of course, there's a lot of upfront work that you have to do, right? You have to write the book or create the online course or create the YouTube videos. But once the intellectual property is created, then it becomes very passive, right? It becomes a very passive form of income because it doesn't require a lot of effort to keep the money coming in, Now, let's go back to business income. I often get questions from people about, how to start a business. And I want to go through the process. I'm going to give you a brief overview of how to start a business. First, you need to choose a business structure, right? Do you want to be a DBA, doing business as, or an LLC, right? A limited liability company, or another type of structure, right? So you choose a business structure based on your specific circumstances. And then you choose a name for your business and register your business with the state, right? And then you get an EIN number from the IRS, right? The EIN number is completely free, right? So, and then you open up a business checking account, and then you get a business credit card, right? So now with your business in place, the question I get a lot is how can we take advantage of the wide range of tax deductions? So as I mentioned, one of the biggest advantages of business income is the access gain to a lot of tax deductions, right? And then you may be wondering, how can I take full advantage of these tax deductions? Well, understanding section 162 of the IRS code is key, right? One of the most important sections of the IRS code for entrepreneurs and business owners is section 162, because it essentially says that you can deduct all ordinary and necessary expenses paid or incurred during the taxable year to carry on any trade or business. So what that means is the moment you start a business, you immediately open up the possibility of tax deductions, right? It's amazing how many expenses that were previously just personal expenses that you now can classify at least a portion of many of those expenses as business expenses, right? For example, consider your cell phone, right? If you start a business where your cell phone plays a role in the operations of your business, then you could take a portion of your cell phone expense as a business expense, right? And think about your housing costs, right? Say that you have a home office. If you use that home office for business related work, then you can start taking a portion of your housing costs as a tax deduction for your business, right? Now, all this must be done correctly, of course. And remember, this education is educational purposes only, right? Make sure that you first consult with a CPA before you make any major moves, right? So here's the thing. There's a lot of tax advantages, right? And there's a lot of tax strategies that you can use, right? For example, hiring your kids is a major tax strategy, right? And then also, there's something called the Augusta rule. I mean, there's a lot of different stuff that you can do when you are a business owner, a lot of tax strategies. So to remind you of why this is so important, I like to repeat that you achieve financial freedom when your passive income exceeds your cost of living. Therefore, you want to be aware of the streams of income and ask yourself, how can I build additional streams of income? And be able to classify your income as passive or active. Because when you build your passive streams of income, you're on the road to achieving financial freedom. Now, let's talk about starting a business. One of the important things about launching a business is having the right plan in place, right? And I encourage you to write a business plan. Write a business plan. Now, there are different ways to write a business plan. I'm going to share with you 7 key sections of an effective business plan. Number 1 is market analysis, right? Market analysis. You want to ask yourself questions like, what problem does your business solve and how does it solve it? Clearly define the solution your business provides and why there is a market demand for your business's solution. Ask yourself, how big is the market demand for that solution that your business provides? Number 2 is your competitive advantage, right? So think about what sets you apart from other businesses in your industry. Is this competitive advantage sustainable long term? What makes your business unique? Right? Why would people hire your business over other businesses that offer the same or similar situations, same or similar solutions? How easy is it for another company to copy your business model? On the flip side, what are the key characteristics that make it difficult for others to compete with you? Right? You want to do a SWOT analysis, SWOT, SWOT analysis. You want to identify and analyze internal strengths and weaknesses, as well as external opportunities and threats. Number 3 is marketing. You want to ask yourself, what are your customers? Who are your customers and how will you reach them? Clearly define your target audience. Create your customer avatar, a detailed profile of your ideal customer. When designing this, consider who has the greatest need for the solution your business provides. What techniques and strategies will you use to bring awareness of your business to your target audience? How will you leverage social media? How will you generate and promote positive word of mouth about your business? How will you create social proof? How will you obtain and display testimonials? Overall, how do you plan to attract your target audience? Number 4 is operations. How does your business provide the solution your customer wants? What is the operational plan? Clearly outline the step-by-step process that your business goes through, including the processes, activities, and responsibilities of each person involved, as well as the time frame of execution. Identify potential challenges and explain your plan for overcoming them. Also, consider what risks are involved in your operational plan? How do you plan to mitigate these risks? Number 5 is pricing. What are the costs involved? List out all the costs, including the fixed and variable costs. What are potential unforeseen costs? What is your pricing schedule, your pricing structure? What are your profit margins? How does your pricing structure compare with that of your competitors? What is your pricing strategy? If your pricing is higher than the average, if your pricing is higher than your competitors, be able to explain why you feel confident charging more. What extra value are you giving that will encourage people to pay a premium for your services? Or if your pricing is lower than the average competitor, why is it lower? Are you working on a strategy to build volume by making your pricing a little bit lower? Carefully think through your pricing strategy, whether it's above market or below market or on par with the market. Think through your pricing strategy. Number 6 is finances. Finances. How do you manage the financial aspects of your business? Explain your bookkeeping and tax preparation system. Describe your business's historical financial state, if applicable. What are your future financial projections? This includes both budgets and financial statements. Does your business have funding needs? If so, how will those needs be met? And number 7 is the executive summary. The final section, the executive summary. This is typically the first section of the business plan. But when creating your business plan, you want to write this section last, right? The executive summary should describe your business, the problem it solves, your target market, and financial highlights. It should grab the reader's attention and briefly explain what your business does. The goal of the executive summary is to spark their interest and compel them to read the rest of the business plan. Now, let's talk about building and leveraging business credits. Optimizing your finances involves 2 things: having money and having access to more money by leveraging credit. The first topic is this: what is business credit and how is it different than personal credit? So your business credit score tells lenders how creditworthy your business is, and your personal credit score tells lenders how creditworthy you are as an individual. Now, why is business credit important? Well, there are several reasons, right? Number 1, the ability to borrow money under your business name instead of your personal name, that's important, right? That's very important. And it really goes along with the mindset of, own nothing but control everything. If you study wealthy people, you will notice that many of them, they really own nothing in their name, but instead they control everything through their businesses and trust funds and corporations. Number 2, business credit is important because it keeps your business liabilities separate from your personal liabilities. If you set it up correctly, your business debt will not show up under your personal credit report. And therefore, you can leverage business credit without any impact on your personal DTI ratio, right? And you know what DTI stands for, right? It stands for debt to income ratio. And maintaining that through the use of business credit is a very powerful aspect of borrowing. When done correctly, your business credit, including the loans and debts under the name of your business, will not show up under your personal credit report. Therefore, it will be unable to impact your personal debt to income ratio. Now, next one, it provides more leverage than personal credits. For example, business credit cards have higher spending limits than personal credit cards, making them a more powerful tool, right? Now, how do you build business credits? All right, I'm going to take you through some steps regarding how to build business credits. Number one is set up and operate your business professionally. You want your business to be legit, right? To do this, you got to choose a business structure. Most likely the best structure for your situation is an LLC, but be sure to research based on your specific business goals and circumstances. So you want to choose a business structure and then choose a business name and register your business on the state level through, your Secretary of State, right? So it's like a state website, right, that you can go to register your business. And then you need to get an EIN number through the IRS website, right? And open up business bank accounts. And you want to optimize. Now, here's the thing. You want to optimize your personal credit report, because when you initially apply for business credit, the creditors will look at your personal credit score and your personal credit report to determine how much business credit to give you, right? Now, in another chapter, I go into how to build and maintain an excellent personal credit score. But I'll go over the basics here. 5 factors are essential to building your personal credit score. Payment history, right? Making your payments on time. Credit utilization, meaning keeping the percentage of your keeping the percentage low regarding the amount of debt that you're using in relation to the amount of debt that is available for you to use, right? Keeping that credit usage low is credit utilization. Credit age, which is like how long your accounts have been open, which is why it's so important to start early to build your credit and build lines of credit so that you start early to build up an age for your lines of credit. What else? Credit inquiries is another thing, right? When you apply for a line of credit, the creditor will inquire about your credit score, right? And causing an inquiry to go on to your report, right? But don't worry, those inquiries will fall off, after a certain amount of time. And also your credit mix, which is basically, it's the diversity of types of credit that you have, right? So there's installment loans and there's revolving credits, right? And so you want to have a good mix of credits, right? So in whole, you want to optimize your personal credit report and personal credit score in order to optimize your, in order to really qualify to get great business credit, right? So now you get a business credit card, right? And here's the thing, not all business credit cards are of the same quality. You want a business credit card that reports to all the major commercial credit reporting agencies, right? And that does not, and you want to make sure that the business credit card that you get does not show up on your personal credit report. There are some business credit cards that will report on both your personal credit report as well as your business credit report. You don't want that. You want to only deal with business credit cards that will report only onto your business credit report, not on your personal credit report. Also, use specific vendor trade lines. Ideally, you want to find trade lines that report activity to the major commercial credit reporting agencies. The way you're going to build business credit up fast is primarily from the reporting of the activity from trade lines that your business is involved in, right? So examples include Uline and Quill and Shirtsy, but there are many others as well. So do your research and find trade lines that report to the major credit reporting agencies. Now, one of the biggest and one of the most important agencies, right, when we're talking about major commercial credit reporting agencies, business credit reporting agencies, one of the major ones is an agency called Dun and Bradstreet. So make sure that you really look for trade lines that report to Dun and Bradstreet, right? And that's huge. Now, Of course, always pay your bills on time, right? That's important. Pay your bills on time. In fact, pay them early, right? Now, visit Dun& Bradstreet website. And as I said, they are one of the major business credit reporting agencies. Check out their website at www.dnb.com and see if your business has been assigned a DUNS number, right? The DUNS number is a business identification number in the Dun & Bradstreet commercial credit database. Most likely, if you followed every step of registering your business and getting a business credit card and using vendor trade lines, most likely your business will have automatically been assigned a DUNS number. If your business has not already been assigned a DUNS number, you can be proactive in requesting a DUNS number. Now, next, open up a free NAV account, N-A-V, NAV account. You go to www.nav.com, right, nav.com, to open up a free NAV account. And this NAV is the main business credit monitoring service, right? It's the main credit monitoring service for business credit scores. And so NAV is essential. NAV is essential in managing your business credit. From your NAV account, you'll be able to see at least 3 of the major business credit reporting scores for your business, including your Dun & Bradstreet score. Now, the business credit score that they give, okay, is actually called the PAYDEX score. So the business credit score that comes from Dun & Bradstreet is called a PAYDEX score, and it ranges from 0 to 100. In general, a score between 0 and 49 is considered high risk and makes you a bad option for creditors to invest in. So this is a bad score. A score between 50 to 79 is medium risk, but a score between 80 to 100 is low risk. So the goal of every entrepreneur should be to have a PAYDEX score of at least 80, right? Now, understanding the 3 most important wealth building tools will enable you to double, triple, even quadruple your wealth. The 3 most powerful and important wealth building tools are business ownership, the stock market, and real estate. They are like the golden trio, right? So you must understand these tools. When we talk about the stock market, the absolute master key to success is starting early to invest. Begin investing early, right? Because that way you take full advantage of the power of compound interest. Now, what is compound interest? Compound interest is basically where you're making interest on your interest, right? So you invest and your money makes interest, but that interest gets reinvested. And so you get to a point where you're making interest on the original amount, as well as making interest on the interest that has been earning, right? So it's amazing, powerful, powerful. You may have heard of the penny versus $1 million dilemma, right? So for example, suppose you're given 2 choices, receive $1 million today or receive a penny that doubles daily. Now, a lot of people will think, oh, well, definitely the smart choice is to take the $1 million today. But no, you should take the single penny, because if it doubles daily, that means, so day 1 is 1 penny. Day 2 is 2 pennies. Day 3 is 4 pennies. And if you keep going, in just 30 days, you'll have $5,368,709, right? Do the math. It's amazing. It's amazing. That's the power of compounding, So here's my point. The earlier you start to invest, the more you can take advantage of compound interest, and the faster your funds will grow. It's amazing. Also, understand the tax advantages of a Roth IRA, right? So with a Roth IRA, it's an individual retirement account, right? So a Roth IRA is a type of individual retirement account in which you are contributing funds and you are not taking any type of tax deduction on the contributions that you contribute, right? So there's no tax, it's taxable, right? So you're not able to take any tax deductions, right, as you are contributing to the Roth IRA. But the advantage is that the money in the account will grow tax-free. And when you are in retirement age, when you're withdrawing money from the fund, right, the money that you're withdrawing is tax-free. So it's a very powerful vehicle. To understand the tax advantages of a Roth IRA is very, very important, right? And now, also understand why index funds are the best type of mutual funds, right? Index funds are the best type of mutual funds because their expense ratio is super, super low, right? It's a low cost associated with index funds, right? So now also understand the importance of building and maintaining an excellent credit score, right? So we're talking about like in real estate, right? Investing in real estate, if you have a good credit score, it's amazing how so many doors will open up to you, right? Because you'll be able to qualify for bigger loans and you get better terms, when you have a great credit score, Now, let's talk about multiplying money, right? Now, retirement. Let's focus on retirement. What is retirement? Well, retirement is the part of your life in which you are no longer working. The general game plan of the average 9-to-5 working American is to save up enough money in your retirement accounts so that you can live the rest of your life solely off the withdrawals from your retirement account. Now, how much do you need to have in your retirement account to live your desired lifestyle during retirement? Well, a general rule of thumb says 25 times the annual amount that you wish to live on, right? So it's when you do the math, it's like, for example, if you need $50,000 per year, right, to live your desired lifestyle in retirement, then you'll need 25 times that amount to be in your retirement accounts. Okay. And so 50,000 times 25 is 1,250,000. Now, here's the thing. The earlier you start investing for retirement, the easier it will be to reach the amount that you need to live your desired lifestyle in retirement. All right, because remember the power of compound interest. Compound interest is the most powerful tool for growing your money, right? Now, the stock market has its ups and downs, but looking at the history of return on investment, it averages around 10%. 10%. All right. In fact, it's a little bit over. If you look at the math, it's a little bit over 10% that it averages. So we'll use the number 10% in our sample scenario. Now, taking the average annual interest rate of 10%, a 35-year-old would need to invest $443 per month to reach $1 million by the age of 65. An 18-year-old, however, would only need to invest $79 per month to achieve the same goal by the age of 65. It's amazing, the power of compound interest. Again, the earlier you start saving and investing for retirement, the easier it will be to reach the amount that you need to live on. To reach the amount that you need to live your desired lifestyle in retirement. Now, let's go over some key types of retirement accounts. Here are the main types. First is the 401k. Now, what is a 401k? A 401k is a retirement account sponsored by an employer, right? And this option is only available for people who have a regular, like 9-to-5 job, right? Regular W-2, employee, right? Now, if you're self-employed, you can't get access to a traditional 401k plan, right? And also, even if you are traditionally employed, not all employers offer a 401k plan, right? So let's see. So now the money. Okay, so now if you are all right, so now if you're fortunate to be offered a 401k plan, right? The way it works is a predetermined amount, right, chosen by you upon opening the account will be removed from your paycheck and deposited into, this fund, this account, right? Now the money then can be invested in a number of ways, often with mutual funds or stocks offered by the employer. Now another benefit of the 401k is the employer match. Oftentimes, an employer will match your contribution. So basically give you free money. They'll match you up to a certain percentage, right? Sometimes it might be like they'll match you up to 5% dollar for dollar, or maybe they'll match you up to 3% dollar for dollar. And then for the next 2%, they'll match you 50%, like 50 cents on each dollar that you contribute, something like that. But anyway, basically, it's free money. The employer match is free money that they will give you, right? Not all employers offer it, but some, many do. Many do. So now, on top of that, also, of course, it's a tax deduction, right? You don't have to pay taxes on your contributions to a traditional 401k, but you do have to pay taxes later when you're withdrawing money from your 401k during retirement, right? So the traditional 401k is especially beneficial to those who are currently in a higher tax bracket, right? Because they're able to take that tax deduction, right? Now let's talk about the Roth 401k. A Roth 401k is similar to the traditional 401k, with the big difference relating to taxes. So with the Roth 401k, the contributions you make into a Roth 401k are not tax deductible, right? So you have to pay taxes on that money that you contribute. But however, the big thing is this: the amount, the money grows tax-free. And upon retirement, as you are withdrawing money from your Roth 401k, you're not paying any taxes, not at all, right? Now, the next is an IRA. Now, remember how I said the 401k is only available for people with a traditional regular job and only if the employer offers it, right? So what about self-employed people, or what about people who are on a job that doesn't offer 401k, right? What can they do? Well, IRAs, okay, which stands for individual retirement accounts. IRAs are available for anyone, right? Now, what is an IRA? An IRA is a retirement account that functions similarly to a traditional 401k, but it is not sponsored by an employer. And as a result, there is no match, and the contribution limits are usually lower. And so now, what is a Roth IRA? So like a traditional IRA, Roth IRAs are vessels containing a variety of investments that aim to grow your money for retirement. However, contributions into a Roth IRA are not tax deductible, right? Like a traditional IRA, they're not tax deductible. So traditional IRAs, you can take a tax deduction, right, for the contribution. But Roth IRAs, you cannot take a tax deduction. However, the key about Roth IRAs, the advantage about Roth IRAs, is that upon retirement, the money that you withdraw from your Roth IRA in retirement is tax-free, right? So kind of similar to the Roth 401k, right? So that's what that is. So now, those were just four of the main types of retirement accounts. More exist, but those that I went through are four of the most popular ones. Now, I say all this to say is that, one of the things that's super clear is that you want to start early to invest. Start early to invest, So now, here's the thing. Let's see. Okay, now, side note, regarding which mutual fund you should choose to be in your Roth IRA account, right? So I'd really encourage people, everyone, to set up a Roth IRA. But what mutual funds should be in your Roth IRA? I highly recommend that you research, right? Because you definitely do not blindly follow any type of advice. Always do your own research. Always take the advice and always do your own research. Now, that being said, here's my suggestion. Research index funds, because index funds are a type of mutual funds that they basically just like their holdings basically just match a particular market index, such as the S&P 500 index, right? Or any of the other types of indexes, right? So, for example, two index funds that I'd like for you to investigate are the Fidelity 500 Index Fund and the Vanguard 500 Index Fund. These are two very popular index funds that track the S&P 500 index. Now, index funds have a lower cost compared to regular mutual funds because index funds are passively managed, whereas regular mutual funds are actively managed, right? So that is what, so now, discussion questions. Summary, summary of the chapter. Work becomes optional when your passive income exceeds your cost of living. Action item, make a list of your present income streams, right? Also, write a business plan. And now, discussion question. What income streams do you plan to have in the future? Right? Also, another discussion question. Explain your business plan. And now a quiz. Why is it important to have multiple streams of income? And final quiz question. How can you write a business plan?